I thought we should update this particular presentation I made back on the 10th of June regarding the Red Sea and potential closure. Back on the 10th of June, the question raised was whether a Houthi re-escalation would compound the Hormuz shock. Well, 5 weeks on, we've got the answer, and it's come the hard way. So the 17th of June Memorandum of Understanding between Washington and Tehran briefly defeated the Houthis. Metals gave up war premium, urea retraced hard, and the algorithm kept us patient. Then the deal collapsed. The IRGC struck a container ship in the Strait on 11th of July. CENTCOM answered with roughly 140 strikes. Iran hit 5 Gulf states in reply, and on the 14th of July, the Houthis formally entered the war with strikes on Saudi Arabia. So we're back at the dual choke point, but with a twist. The Red Sea spent June as the Hormuz workaround, carrying 7.4 million barrels a day. The Houthi entry threatens the workaround itself. Framework is all, yes. So, on the 8th of June, Houthi ban was never enforced. By early July, Maersk and Haploid were actually resuming some Red Sea routes. Repeated threats decayed in credibility until acted upon. So on the 5th of July, a cargo vessel was attacked southwest of Al-Duhudiyah. And on the 14th of July, the Houthis formally entered the war with reprisal strikes on Saudi Arabia. As far as Hormuz, the MOU signed 17th of June never really materialised. Iran redeclared closure within days, citing Lebanon. Trump declared the deal was over on the 8th of July. On the 11th of July, the IRC struck a Cyprus-flagged container ship, and CENTCOM answered with its largest strike package of the war, about 140 targets. Port Watch counted roughly 10 transits on July 12th against a pre-war average of around 88 per day. BIMCO's misidentification point stands. The struck ship had merely switched off its transponder. That tells every Western operator they are in someone's sights. Okay, 2 critical arteries. The numbers are in front, but the structure has changed. In 2023 to 25, the Cape absorbed the Red Sea shock because Hormuz was open. The 2026 relationship inverted. With Hormuz contested, the Red Sea became the workaround. The Saudi east-west pipeline to the Red Sea coast, the UAE bypass, and petroleum through Bab el-Mandab rose to 7.4 million barrels a day in June. That's an increase of from 4.1 million a year earlier. So the Houthi closure now does not remove an alternative, it strikes the alternative. With urea 80% since February peaked above $8.50 a tonne in April, then war premium bled out post-MOU. The benchmark is back near $4.23, though it has rebuilt 14% in the past month. The World Bank still projects urea up roughly 60%, the price of urea up roughly 60% during 2026 as a whole. The whipsaw is the lesson. Premium decays on paper deals. Structure persists. The gap between what is priced and what is happening is where our live trades are. Okay, energy with the updated numbers. Crude, Brent around $85, showing remarkable restraint given 3 consecutive weekends of US-Iran exchanges. Carried 7.4 million barrels a day in June. That flow is exactly what the Houthi entry now puts at risk. LNG. Ras Laffan was struck in March, very early after the war was first started. Its capacity was down roughly 17%. Force majeure declared. Repairs estimated at 3 to 5 years. That is structural, not headline. Japan's supply geography has not changed. Neither has EWJ. Tanker rates. Gulf war risk premiums are running 8 to 10 times the pre-crisis baseline. And the Lloyd's Joint War Committee listing will not come off until a sustained incident-free period, which the last fortnight has pushed further away. Insurance normalisation lags physical security by months. That cost flows into every imported good. So just having a quick look at portfolio thoughts. The GLD continues to be underpinned in the longer structural case. QQQ bear continues in the longer term, as does the existing EWJ bear thesis with a January 2028 leap put. The fertilizer cascade with an honest update, because the picture is more nuanced than in June. The cascade mechanism is intact. Roughly a third of seaborne fertilizer trade tied to the Gulf. Iran's ammonia halted, Qatar's urea and sulfur suspended, plus prices whipsawed. The urea benchmark peaked at $850 in April, retraced hard after the MOU and sits near $423, 50% down, though it's up 14% in the last month as re-escalation rebuilds the premium. US retail urea is $714 a tonne, up 9% so far this year. DAP retail at $912, up 13% year on year. Liquid sulfur has tripled since the end of 2024, and China's sulfuric acid ban runs through until at least December. Repeated, at least this December. The NDU-SU scenarios, 782 to 996, depending on conflict duration, remain the roadmap if this extends. For our DBA bull call spread, the 3 to 6 month transmission lag means the February to April cost shock is reaching consumer food prices about now in the third quarter. With the July re-escalation queued up behind it as a second pulse, we're in the early innings. The algorithm is tracking DBA. Okay. Base metals and working capital. The metals, copper is selling around 13,500 per tonne on the LME, holding the 13,000 to 14,000 range it has occupied since May, refusing to break despite the macro. Aluminium is at 3,145. So why won't copper break? Supply. The acid channel. Gulf states supply roughly 45% of the world's sulfur. China banned sulfuric acid exports from May through till at least December. That's around 3 million tonnes off the seaborne market, and roughly 15% of global copper output depends on acid leaching. Chilean output was down about 6% in the first quarter. But meanwhile, the LME copper stocks have fallen more than 20% since the end of May, to a 4-month low near 305,000 tonnes. The working capital trap does the rest. 3 to 4 extra weeks of inventory in transit, financed at today's rates across every metal-consuming supply chain. For Korean and Japanese fabs, it is the triple squeeze: energy, metals, and logistics, which is why EWY and EWJ read through, and the structural backdrop for FCX when the algorithm confirms. So we've got the fundamentals first, the algorithm is second, execution third. The C variables updated. War risk insurance, 8 to 10 times the baseline price. Mechanical, intermediate, and sticky, because the JWC will not downgrade until 60 to 90 incident-free days. Every escalation weekend resets that clock. Container rates. July GRIs are landing on a fleet already stretched by Cape rerouting. Asia North Europe spot runs 40 to 55% above the pre-crisis median. And the June peace headline that knocked freight futures down 9% in a single day has fully reversed. Bromine and DRAM. The ICL Dead Sea Channel into Samsung and SK Hynix stands. And now China has blocked helium exports, citing war supply disruptions. 2 semiconductor inputs squeezed at the same time, and almost nobody in the mainstream is covering it. Japan, still sourcing 95% plus of crude from the Middle East. LNG costs and goods inflation compound simultaneously. Thus, the EWJ bear thesis is strengthening with every week of elevated import costs. Food price lag, the biggest medium variable. The February-April fertilizer shock reaches CPI in the third and fourth quarter 2026. It's coming through now.